Good day, everyone. I'd like to welcome you guys back to my YouTube channel. So in the previous videos, we were working on life sciences. So if you haven't checked that video, please do. I'll leave it in the description box, and also you should be able to see it in this video as well. So in this video, we are beginning with the Maths Lead grade 12 caps breakdown. Okay, so we'll be going through each and every chapter, each and every topic. So if you really need a request, or you want to request a topic that you think that we should do, please write that down on the comments. Okay, and please let everyone know that we are here for them. Everyone who is rewriting, maybe who will be doing grade 12, who's doing amended metric, everyone, guys. We need everyone in this channel. We want it to grow bigger and bigger. Okay, so please subscribe, share, like, and comment. Okay, so let's begin with this then. Right, so in this video, we'll be focusing on financial documents, particularly the loan documents and the tax documents. Okay, so I'll just divide this video into two parts. I'll have part one will be focusing, of course, on your loan documents, and then part two will focus on the taxation, everything that you need to know concerning tax. Okay, and then we'll move on to tariffs, so on and so on, guys. Okay, so let's begin then with these documents. Now, every day, or let me rather say, in our lives, we receive a lot of financial documents, and it's either us or your if you are staying with someone who's working, um, or someone who has an account statement with a particular store. Okay, so they will always receive these letters each and every month. Okay, so we have to be able to read these, and you should be able to know some of them from grade 10 and grade 11, of course. Now, in this video, we should be able to accomplish understanding the terms, or rather being able to define and differentiate between the terms of a loan, okay, and an interest rate. Okay, the terms, the conditions that are there. Remember, each loan differs from, of course, banks. Banks offer different types of loans. They have different types of terms as well. Okay, so these will differ, and we'll explore some of these as well. We'll also look at how does these relate to each other, the monthly charges and interest rates, and how are they part of the loan as well. Okay, and also explore the effect of a change in a monthly repayment. Remember, monthly repayment changes, guys, and we will see how and why. Look at statements from banks and loan agreements, of course, these changes. Okay, and we'll explore some of these terms as well. Okay, so let's start with the loan, guys. The simple definition of a loan. So the idea is, um, so let's say this is you, right? You need to buy a car, or you need to buy a home, or you need a loan, guys, to do a particular event, or whatever that you need to do. That would be your personal loan or micro loan. Okay, so micro loan, that's the smaller amount of loan that you would get maybe from someone in the community that you know that, of course, um, 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 can give you money, then you'll give them back, of course, with interest. Okay, so microloan is a smaller amount of interest, of course, with relatively lower interest rates. Okay, so you need a car. Let's say you need a car, and so you head on to the loan, to the bank. I mean, and banks offer loans, guys, right? So that's the primary way in which they make money. They make money. That's how they generate income, by borrowing people money. Okay, so that's what we are saying here. So this is you need to buy a car, but of course you do not have the hard cash right now, or you do not have enough credit in your bank account to buy it, and so you head to a bank, commercial bank, your net banks, your Capitex, so on and so on, and they offer you a loan. Okay, so just for just to make it easy, guys, let's just use smaller numbers. Okay, let's say you borrow 100,000, right? Okay. Now, of course, banks, as I said, terms differ, guys. A bank can give you, let's say, 90% of the loan that you required. Okay, so that means that the bank will give you, let's say, 90,000 rands, right? So and so that means that you'd have to pay the rest, which is 10,000, as a deposit. Okay, so you pay it as a deposit, like that 10,000. So you pay that 10k as a deposit, and then they loan you 90k, right? So 90k you'd have to pay it. Um, they would divide that 90k into, of course, months, and you'd have to pay it back in monthly installments. Okay, so that's what we are saying here. So 100% loan, that would mean that they've financed you all the money that you require in order to buy that particular car or a house. Okay, so so terms again differs. Okay, now the loan that you are going to be paying back, the amount of money that you'll be paying back includes the interest. Okay, so interest, of course, is the money that is added on top of what you had borrowed. Okay, you had borrowed 100,000 rands, and you will pay it back, of course, not as 100,000 rands, of course, but as money plus their interest. Okay, let's say their interest is like 25%. Okay, and you have borrowed um, you have been given a 100% loan, guys, like that. Okay, they gave you 100,000, like that. So 25% of 100,000, which is the loan amount. Okay, I mean the purchase price. This is the purchase price of the car, right? And then you add that interest. So when we calculate that loan amount then now, okay, remember I said that this is the purchase price. Okay, it's not the loan amount, it's the purchase price. You're going to purchase a car with this. Okay, this is the purchase price, the 100,000, right? Now, what they'll do, they'll take that purchase price. Okay, I'm just going to write PP, purchase price plus their interest. In this case, their interest is 25%, which means that it's 25% off the purchase price, right? 25% of the purchase price, meaning which 25% of 100,000 is your 25,000 rands, right? Okay, so this is what this is interest. This is the money that will be added on top of that money you borrowed, which is the purchase price, right? So that means that in total, your loan amount, we're saying that is the purchase price plus the interest, right? We call it an interest when it is written in rands, okay? And when it is in a percentage form, we say that it is an interest rate, guys. Okay, so that's the difference between interest and interest rate. These are not the same. Okay, this is interest. That means that it's the money added on top of that purchase price. Okay, or the money that you borrowed. Okay, so that means the total amount of the loan then is the purchase price plus the interest, which is 100k plus 25k, right? And so that means that the loan amount would then be 125,000 rands. Okay, so that's what you be um, um, paying back in installments. Okay, so you'll be paying. So they'll divide this money then. So they'll divide this by the amount of months that, of course, or the amount of time that you'll be paying it over, right? So if it's 2 years, 2 years, how many months is that? 2 years is um, 2 years is 24 months, right? So they'll divide this by 24. Okay, so they'll divide this by 24, such that every month you would have to pay. So it's 125,000 divided by 24. So each month you are paying 5,208.33. Okay, so this is the monthly installment, right? So monthly installments can also sometimes include service fees, okay, and initiation fees. So these are fees that help process your loan, right? So they can be included in the monthly installments, or sometimes, excuse me, sometimes you'd have to pay them as a deposit. Okay, they're included in the deposit. Okay, so it really differs. Again, terms differ, guys, right? I hope you guys are following me here. Okay, so that's how you would calculate, of course, the loan amount there. Okay, so let's then move on. Okay, so that is what basically what a loan is. Okay, now so we're saying that so while paying um, this amount of money, this 5,208, okay, it's very possible, and banks do these, guys. So banks, what they offer originally, like the standard offer they have, are variable interest rates. Okay, so a variable interest rate changes. Okay, so a variable interest rate changes. So let's say this month maybe you paid that 5,208 and 33 cents. The next month you could be paying 6,200 or 6,300. Okay, the other month you can be paying 4,800. Okay, so as you can see, that the amount that you're paying each and every month changes. Okay, and the reason why is that the interest rate changes. Okay, because you are being offered a variable interest rate. That means it is an interest rate that keeps on changing each and every month. Okay, depending on the repo rate. Discuss the repo rate in a second. Okay, so I get a lot of people asking, why am I paying more money that I'm supposed to do as my monthly installment? Well, it's because you have not applied for the fixed interest rate, right? Because the variable interest rate changes, constantly changes. Okay, and it is influenced by the repo rate. Okay, so for those of you who don't know what a repo rate is, so we said that these banks, okay, so your net banks, yeah, your FNB, so on and so on, they borrow money from the South African Reserve Bank. So this is like the central bank, okay, central bank of South Africa, okay, borrows money to these um, commercial banks, and these commercial banks borrow money to you, okay. So the rate at which they lend this money to these commercial banks is what we call the repo rate, okay. So they can increase the repo rate, they can decrease the repo rate, okay, and of course that directly affects you as a borrower or someone who has borrowed a loan, and so that means your interest rate will change. Okay, so let's say the repo rate increases. Why would we want to increase the repo rate? Why would SARB want to, which is the South African Reserve Bank, why would they want to increase the repo rate? Well, they would want to do this to decrease inflation. Okay, inflation. Remember, inflation is the increase in the prices, or how much has prices increased for a particular period. Okay, so in order to decrease inflation, which is the rate at which prices are going up, in order to counteract that, they increase the repo rate. Okay, so by increasing the repo rate, that means it's very difficult or it's tough for the commercial banks to borrow money from, of course, the Reserve Bank, and so that helps, and so there's less money in the economy. Okay, so and then that helps to decrease the inflation. You don't have to know all of that. Okay, just know that variable interest rate is affected by the repo rate, which is set by the South African Reserve Bank, which lends money to the commercial banks that you borrow money from. I hope that is not. I hope you understood me there. Okay, so we're saying that the repo rate is the interest rate at which the South African Reserve Bank lends money to commercial banks. Okay, so like your Capitec and your Nedbank. Okay, so that means that you can be affected by these changes, of course, because if the variable interest rate increases because of an increased repo rate, that means that the monthly installment that you're going to pay is going to increase. Okay, so from 5,200 all the way to 6,200. Now that is a whole thousand there. So that means that, and it's going to directly affect you. And if you do not have this money, this monthly installment, then you're going to default. And so it's very possible that they take back that home or that car and sell it in order to, of course, save themselves from the investment that they made by borrowing you the money. Okay. So for the fixed interest rate, so it really depends. You have to choose, but you always the standard interest rate is a variable interest rate, and so you always have to um, apply for the fixed interest rate. Okay, you apply for it for the fixed interest rate, and of course it's for a certain period. So if you have been borrowed money, let's say for 2 years, you can apply for the fixed interest rate for a year. Okay, so that means that you are paying constant monthly installment for only a year, and then it then changes, so you have to still apply for another fixed interest rate again in the second year, and maybe during that year the repo rate has increased, and so it's also affected as well. Okay, so it's very important that we know these guys, and that of course we educate others on these, because people do not understand why our monthly installments keep on increasing. Okay, so that is the effect of change in the monthly repayment. Okay, so that's how you would get affected by that, right? Now let's look at some of the conditions that you also have. Now for, excuse me, for your loans, um, you can have something that we call a balloon payment. Okay, balloon payment. Now balloon payment is really simple, the name suggests as well. So of course guys, when you're inflating a balloon, okay, this is a bad drawing, I know. Over time, of course, it's going to get, okay, bigger and bigger, so its volume increases over. So that means at the end, you'll have, of course, a bigger balloon than, of course, at the beginning. So this type of payment resembles that, because it is basically a large payment due at the end of a balloon loan. So that means that you, let's say you own 100,000. Okay, I've been using this example. You own a total loan amount of 100,000, and you, let's say it's for 3 years, but for 2 years you are being charged a very small interest rate. So you pay, in total over these 2 years, you pay only, let's say 40K. And then at the end of the agreement, you'd have to pay back that 60K. Okay, so the interest might be lower at the beginning but increase at the end, or you'd have to pay a huge amount at the end, just like that. Okay, so that's what we mean by a balloon payment. So the balloon payment is higher than what you might be paying towards the loan every month, but the total interest paid can be lower. Okay, so that is what a balloon payment is. Okay, so let's look at a couple of examples, guys. I don't like to talk a lot. We should be doing um, activities. Okay, right. So let's take a look at these. We have 3 activities here. I'll scroll down to other ones when we are done with this. Okay, now we say, so we are being presented, what is this? So SIPO paged through a newspaper, okay, and saw a car advertised with the monthly installment of 1,938.49 cents. CPO will have to pay a deposit of 17,324. Okay, so as I said, guys, the terms differ, right? So this one requires you to pay a deposit. Okay, now that can be beneficial to you if you would not, of course, afford the monthly installments, because what happens is, if you pay a deposit, they subtract that deposit from that total price in this case, which is 115,495. So they would take that deposit, subtract it there, and then the remaining amount, that is the amount that you'll be that will be charged interest. Okay, so if you pay a deposit, you're actually decreasing um, um, the amount of monthly installments that you have to pay. Okay, I will demonstrate this in these questions. Okay, right. So that is the terms, and over here we are provided with a transaction summary. Okay, now guys, I know this can be very confusing for a lot of you guys. Okay, I think we should go through a bit of terminology. Okay, so with transaction summaries, guys, you have what we call as an opening balance. Okay, so an opening balance is simply an amount that that you are charged with. Like that's the initial amount that you are charged with. Okay, that's the opening balance that you have to pay. Okay, so in total, this guy has to pay the amount of 98,171. So that is the balance that is brought forward. Okay, and then of course he is going to have to pay monthly installments each and every time, and this amount will decrease over time. Okay, until he has zero amount to pay. Okay, now we also have what we call credit and a debit. Okay, now we're saying that SIPO has basically an account opened with this particular bank. Okay, and so this account, that means that he will have to keep on putting in money into this account. Okay, um, in that way he is decreasing or reducing the balance that he is owing. Okay, so of course we have a credit. So credit, that is money taken into an account. Okay, that is paid into an account. Remember, he has an account with this particular bank. Okay, this is his account with this bank. So that means when he is paying money into the bank, okay, he is actually reducing the balance. Okay, he's actually reducing the balance. Okay, so let's say for February, so that is the end of February right there. Okay, so over here he has so on the second, so on the 1st of February, the balance brought forward was 98,171 rands, right? And then on the 2nd of February he paid, okay, 1,938 into the account. Okay, that is credit, right? Paying money into the account. Okay, so he is paid 1,938.49. Okay, that's the amount that he is paid. And then on the 7th of February, interest was charged. Okay, the interest of 524.40 rands. Okay, this is what? This is debit. Okay, so this amount is actually being charged to him or charged onto this bank. Okay, so remember he had to pay interest, guys. So and we will calculate that. So I'm just trying to look at the transaction summary here, try to analyze it, okay, before it becomes quite confusing, because I know it can be. Right, so and then on the following month, which is the month of March, he paid again his monthly installment again into this account, and he was charged interest. Okay, so let's get into it then and answer these questions. So the first question says, A, what amount has been settled at the end of the first month if SIPO paid the deposit for the car? Okay, so what amount has been settled at the end of the first month? Okay, at the end of the first month, if SIPO paid the deposit for the car. Okay, now guys, we said that the retail price is 115,495 and he paid that amount. So let's first calculate if what we are seeing here is really correct. So the loan amount, we are basically calculating the loan amount, right? So the loan amount in this case would have to be the retail price subtract or the purchasing price, subtract that, subtract the deposit from that, and that is this is that what results is the amount that will be charging interest, okay, on. Okay, so the retail amount as we are given there is 115, okay, 1,495, okay, and then subtract the deposit, which is 17,000 rands 324. Okay, and so what do we have? So take my calculator here, saying 115,000 rands 425 495, I mean, subtract 17,324. Boom, there we go. So it's 98,000 rands 171, which is exactly what has been brought forward as the opening balance. Remember, they are charging him on the loan amount, and that is how you calculate the loan amount: retail minus deposit. If there is a deposit, if there's no deposit, then they will charge interest on the retail amount. Okay, right. So they are charging interest on this amount now. Okay, right. So this I made a mistake. This can't be the loan amount, but rather the amount that they are going to charge interest on. So the amount of money that he's going to pay back is more than this, right? Okay, sorry about that. So now, guys, they are asking us what amount has been settled at the end of the first month. Okay, now the first month, we've already mentioned that it ends here, right? There's no other February that we see. So that means that this is the end of the first month. Okay. So we are basically calculating how much he has paid at the end of the first month, because he had an opening balance. Okay? To make things easy, look at it this way. He has an opening balance of 98,171, and he has a closing balance, okay, of 96,756. The closing balance, that is when he has paid all his expenses for that particular month. Okay, so he opened with this amount, he closed with this amount, and so the difference in those two amounts, guys, should be what he paid. Okay, I don't know if you guys get me here. Okay, so that's what we are saying here. Here's an opening balance of that, and then here's a closing balance of that. Then how much has he paid? Okay, we cannot say that he paid 1,938.49. Okay, yes, even though that was, of course, money that was put into that, but that is not the amount that he has been settled. Okay, remember we added, or we included interest there. Okay, so the easiest thing to do is to take the closing balance and you subtract it from um, the opening balance. So saying that is going to be 98,171, subtract that, subtract 96,756.91 from that. Okay, so let's put that on the calculator. 98,171 minus 96, 757, 756.91, right? So that means that he must have paid, um, must have settled this amount, which is 1,414.09. Okay, so that's how much he should have. That's how much he has settled for that particular month. Okay, so you basically just look at these values, look at where he started, or you can just take this 98,171, subtract this 1,938.49, and add that 524.40, and of course you will get that amount. So of course you will get this, which is the 96,756, and so this is the closing amount, and then you subtract these two there. Okay, if that is confusing, then do what I've told you. So, and then B says, show how the interest amount of 516.84 was calculated. Okay. So what do you look at, guys? Now, interest speaks a lot. Okay. So if you like look at this, 6.41, sorry about that, 6.41% per annum compounded, that means calculated monthly, on a monthly basis. What this means, guys, is that this amount of interest will be charged on the closing balance of the previous month. By that, we mean that um, the interest of 516.84, I think they made a mistake here. Yeah, I think they made a mistake. The comma should be here. So it's 516,484. Yeah, or comma 84. Yeah, I think they made a mistake there. So let's look at how this was calculated. So this is interest for this month. but it should have been calculated on the closing balance of the previous month. Okay, so that's how you do it. So on the following month, this is we'll use this number, this closing balance for March, to calculate the interest that we will charge on April. Okay, which is 6.41% of this closing balance. Remember, this is compounded monthly. Okay, if it was compounded quarterly, then we would we would look at after 4 years, we then charge like that. Okay, so over here, because it is monthly, that means that every month we have to calculate interest. So we have the previous, because this is March, right? The interest that was calculated here is March. So that means we are going to use the previous or the opening balance of March, or the closing balance of Feb. So which is going to be 96,756.41 multiplied, guys, by, okay. Now we first divide that 6.41 by 100. Okay, so first to take out that percentage sign there, so we'll say 6.41, divide that, so we'll divide that by 100. That's the first thing that we should do, and we get 0.0641. Okay, that's what we get, and then we use what we have there to divide it by 12, because if they say compounded monthly, you divide by 12. If they say quarterly, you divide by 4. If they say annually, you divide by 1. Okay, so this means that we are going to take that 0.0641 and divide it by 12. Okay, divide that by 12, guys. Okay, that's what we're going to do there. Divide that by 12, right? And then answer that we get here, we are going to multiply it by that closing balance there. Okay, so in other words, basically saying that this is your 0.0641, and then divide this by 12. Okay, I've already divided that 6.41 by 100, so now I'm going to divide this by 12. Okay, first divide it by 100 every time. Okay, and then divide it by whatever it is compounded by. So it is compounded monthly, that's why I'm dividing by 12. And then so we say 0.0641 divided by 12, and then multiply that answer with 96,756. Okay, and guess what? We have 516.8383. So that is 0.8383, and so that means that when we, of course, round it up to 2 decimal places. So if we round it up to 2 decimal places, then we look at of course, the next digit to the right. Is it greater than 5? If it is greater than 5, then this second digit will go up. If it's less than 5, this digit will remain there. Okay, because the next digit, which is 8, is above 5. There, that means that we are going to increase this digit by 1, which is going to be 4. So 516.84. Okay. Second question, third question. Third question says, what percentage of the price I'm using what percentage of the price, okay, meaning which the retail price, does Zippo pay as deposit? Okay, so we know that the retail price is 115 1,495, but he paid this percentage of deposit, which is this amount of deposit, I mean, of 17,324. So we're basically trying to express this amount he paid as a deposit, but we're trying to express it as a percentage. Okay, so that shouldn't be difficult. So it should be 17,000 divided by 150,000 and then multiplied by 100. That's how um, you carry out those calculations. So we are saying that we'll take that 17,324 and then we'll basically divide that up, okay, by the retail price. Okay, so the retail price, which is the total, which is 115,495. Okay, 115,495. And then what do? We then multiply all of this, okay, by 100, right? So first calculate that, then multiply everything else by 100. Okay, so with fractions, you can sometimes go wrong. So first calculate, start with the fraction. That's what I did there as well. Started with the fraction and then multiply later on. Okay. So and then what do we get? So whatever that we're going to get here, we're gonna that will be our percentage. So 717,224 divided by 115,495, and then we multiply that answer that we got there by 100, and then we get 14.9999. So that means that we can basically just convert that, or so to the nearest, of course, percentage, which is 50%, right? So that is how we would, of course, answer these questions, guys. Okay, right. So let's just carry on then and look at the next activity there. Okay, so this is based on car loans, guys. Okay, remember, we're still dealing with loans. We will look at taxation in the next video. Okay, what is this? Okay, so look at this. Okay, so we have a table here, monthly repayments. The first row is monthly repayments on 1,000 rands. Um, no, this can't be right. It can't be. A monthly repayment, guys, can't be correct. Look at this. You have a monthly repayment, right, on 1,000 rands. That means that you have borrowed 1,000 rands from the bank, and then the interest rate is 15% of 1,000 rands. 15% of 1,000 rands, guys, come on, it's 150, right? And this is 485. I think this should be 10,000, right? Oh yes, there it is. Say yes, it's 10,000. Doesn't make any. It didn't make any sense. So should be another zero there. Okay. Okay. So this is what we have. So I guess these are different loan periods. Okay. So this you pay over 36 months, this you pay over 48 months, this you pay over 60 months, and of course there are different monthly repayments. But also look at the bottom as well. Okay, we have interest rates here. Okay, the highest interest rate we have is 15%. Okay, so 15%, that's 485, makes sense. This is 14%, so it lowers so on and so on. Okay. So and then you have monthly repayments on 20,000 rands. Okay, so we have different loan periods and of course different interest rates. The first question says use the information in the table to calculate the total repayment amount for a loan of 10,000 rands taken over 24 months. Okay, so guys, it's this is how we do it. Remember, you are given the monthly repayment, right? Which is 485 rands. So it's a 485 rands that you're going to pay each and every month, and you're going to pay it over 24 months, right? Over 24 months, and you just basically multiply those two, and you should be able to get 11,000 640 rands. Okay, so that is the total repayment of that 10,000 taken over 24 months, right? The next question says, how much money will the bank make in interest over 24 months? Okay, in what? In interest, right? Remember, I said that interest, of course, is the amount that is paid right above or just above or added on top of the loan or the amount that you have been loaned. This guy has been given 10,000, right? And now he's paying 11,640. So how much was he charged as interest? Okay, so we look at the difference between those. So 11,640, and we'll just subtract the um, the loan amount. Okay, which is, or rather the amount that he borrowed, which is 10,000, right? Okay, so I really like to confuse the loan amount and the amount that is borrowed. That can be confusing sometimes. Okay, so and then what do we get? So we're saying that 11,464 subtract 10,000 there. So he's actually paying 1,640 over the amount he borrowed. Okay, right. So this was okay. Um, not very challenging. Okay, so let's look at this third activity, and then we'll wrap up part one. Okay, so Mandla currently pays 3,500 a month on rent. His monthly income is 16,500. Okay, all right. He considers buying his own house instead of renting. So he wants to buy a house. So I'm sure he's looking for a house loan. In South Africa, first-time home buyers, homeowners, can qualify for 100% loan. So that means that the loan that you're borrowing, you're going to get exactly all of it. Okay, if you borrow 100,000, they are going to give you 100,000. Okay, so it then changes. If you're not a first-time home buyer, then you are going to pay probably 80%, 90%. So that means that you're going to have to come up with the deposit, which is then 10% or 20%, depending on the terms, which means that they do not have to pay a cash deposit. That's what it means. Okay, you don't have to pay a deposit when it's 100% loan. Moreover, the law states that okay, monthly repayments may not exceed 30% of the buyer's gross salary. Okay, right. So the gross salary, guys, is like the total salary. So in this case, the total salary, his total salary is 16,500. This doesn't mean that he actually takes home 16,500. Okay, there are deductions and stuff. We will look at that when we are doing taxation. Okay, so he may not. We're saying that the law states that monthly repayments may not exceed 30% of the buyer's gross salary. Okay, all right. Mandla uses the online bond calculator to check if he can afford the house. The purchase price to buy the house is 500,000 rands. So that's the retail price. That's the purchase price. So that means that this is the amount that they're going to loan him or borrow him. But he's going to pay back, of course, this amount plus interest. Okay, let's look at these questions. A says, calculate how much can Mandla spend on a monthly bond repayment. How much Mandla can uh, how much can Mandla spend on a monthly bond repayment? Well, the law states that monthly repayments may not exceed 30% of the buyer's gross salary. So he can only be able to spend 30% of his of his gross salary, which is 16,500. So what we're going to say, 16,500 rands, okay, and then we take 30% of that, okay, multiply by 30. Remember the percentage sign, guys. We said that means you divide by 100, right? So divide, okay. Let me rather use white. So divide by 100. So dividing 30 by 100, right? So that is 30% of his gross salary, and so he can be able. That means that he can be able to spend. Let's okay. So we can multiply by 16,500. So that means that he can be able to spend a total amount of 4,950 rands. That's the maximum amount that he can spend, okay? Because the law says so. Right, so let's move on and look at B. B says, can Mandla afford to buy a house with the purchase price of 500,000 to be paid over 30 years? Okay, over 30 years. So there we go. We have options here. So as you can see, guys, that over 30 years, the monthly installment is 4,023 rands, and this is below what Ken Mandla pay. So that means that he can definitely pay. He can be able to afford that. Okay, and remember to reason. Okay, why he can. Okay, so we can say that 30% of his, okay, our reason there, 30% of his gross salary is above this monthly installment. Okay, so that means that he can pay, right? Okay, so that is our answer there. So we're saying that it's above the mentioned monthly installment. Okay. Okay, right. Let's move on to the next answer, the next question then. Right. So the next question says, how much will he save um, if he takes a bond over 20 years? Oh, okay. I'm reading D. C says, how much will he repay in interest on the bond over 30 years? Well, interest, guys, let me rather provide you with. So interest is always going to be loan amount that he has to pay, subtract the purchase price, okay, or borrowed amount. Okay. Let me rather use purchase price. Okay. So in this case, the loan amount over 30 years is 1,448,300 320 rands, guys. Okay, you should be able to read numbers and write numbers in NetSlit as they examine that. Then subtract the purchase price, which was 500,000. Okay, so that means that he paid an interest. So 1,448,322 rands, 0.71. Subtract 500,000. So that means he paid 948,320.71 extra. Wow, that's a huge amount. Okay, so that means that this is what the banks have made as like their profit from you. Okay. You're paying 948,000 back on top of what you borrowed. That's how they make money. D, I don't know. Okay, so D says, how much will he save if he takes a bond over 20 years instead of 30 years? How much will he save? Guys, when you're talking about saving, always has to do with subtraction. So in 30 years, the total cost is that, but for how many years? For 20 years, the total cost is a bit lower, yes. So we can just subtract these two here and see how much he would have saved if he, of course, chose. Because can he actually cannot afford the 20 years according to the law. So saying that 1,448,320 rands and 71 cents, subtract 1,000,000 and 79,000 and 671 rands, 0.15, and then we get so we say, I'm actually using a calculator, guys. That is 1,079,671.15. So that is 300. He would have saved 368,649 rands, 56 cents. So he would have saved a lot of money there, guys. Wow. So okay, and then the last question: what effect do the increased monthly installments have on the loan amount, on the loan term? So if we increase the monthly installment, that means that we're going to pay over the we're going to pay off the loan amount over a short period of time. Okay, right? So increase. So we're basically saying that increased monthly installments reduce, because if you're paying large stacks of money um, each and every month, then you're actually reducing um, the long term. Okay, because that means that you're paying the money and putting in stacks and stacks. Of course, that the amount of money that you pay will reach to the amount that you owe, and hence that will happen over a short time. Okay, so yeah, that's what we are going with there, right? Guys, let me know in the comments what you think, and please like again, subscribe, share to others. Okay, share, guys. Sharing is caring, right? Okay, so for the second part, I'll be doing text forms. Okay, bye, guys.